How to trade an increasing bear sentiment leading to reversal. So this is again when the markets are particularly oversold and the market's moving down. Now you have to be careful when trading these, because it's not the strong imminent bull reversal when all the indicators are telling us that a strong up move is imminent. This is where there is still bears in the market. We're still pushing the market down, but the reversal and buyers are starting to join the market. Okay, so we can look at that in a simple example, something like gold that's trading right now. So if we just double click to open the charts as normal, I've already got the charts open, so we can see that gold with these two big selling red candles, we've rejected a close above the 50%. So as you can see, the 161 retracement, the 100% retracement have done their job. They've acted as resistance. The market is tested the 50%. Again, it sat on that as support when we finally broke through. The 100% retracement, 161, and ultimately the 261 spot 8 have been targets for gold to come down to. Now, the reason this isn't an imminent reversal is there's still bears in the market. We can see this huge rejection, okay, of where gold spiked up and people believe that gold was going to start a new rally. The market's consolidated and broke back down. So it is a good opportunity in the short term to buy, but we're not getting these buyers into the market right now. We can see that when we look at the different time frames. Now, the reason this looks slightly different, this hourly chart from yours, is all I've done is I've just taken the RSI indicator just to visually put it onto your screens and show you the overbought and oversold territory. Okay, so the market again is mirroring what the RSI is telling us, that the market is coming back down, the market is selling off, and people are buying into these retracements, but you can't hold onto them for any length of time. So this is an hour chart, but every time we've hit the tops, okay, we've hit back to the 161.8 retracement, but every time we've hit the tops, the market then is looking, to carry on that further bit of selling momentum, to push the markets down, to get every long out of the market, and then to go finally back up. So I'm looking at this on the 15-minute view and the hourly view. So what we're trying to do is understand, is it worth selling in to the rest of this bearish sentiment, or is it best to wait until the market's tied itself out, every seller is out in the market, and then you buy back up for that reversal? So we can either do that in this hourly scenario, because we're still on the increasing bear sentiment leading to reversal, or we can wait for the market to continue to sell off and then get for the sentiment to be the imminent bull reversal, which will give us a greater edge. So it's entirely up to you how you view gold. Okay, so really what we're doing now is the market is still really ranging between key support and resistance lines. So what I would do is I would say, if we break below the 261.8, if we don't make it a concerted effort to get down to this lower Fibonacci retracement down here, the low levels here at 1241, then we'll see like pin bars. So you let the market break off. I wouldn't necessarily sell into it. What I do is let the market aggressively sell off, come back to these low levels of which will now be support, and then buy back to get back to the moving average. Because if you look at the hourlies, we're hanging on to the Bollinger Band. And you can see in the past that when we break outside the lower end of the Bollinger Band, the market doesn't like it. Okay, and that's why I have Bollinger Bands on the hourly charts, because really when we trade outside them, rejection, the market comes back in and eventually gets back to the moving average. So what I would suggest is that because we're not on the imminent bull reversal, we'll let the market push down as far as we can outside of this lower Bollinger Band, and then look to get back and use all these key levels as a point of attraction. Okay, so I wouldn't want to buy right now, because as I say, we're not on the imminent bull reversal, the lowest of the iView sentiment. So the market can still use the rest of that bearish sentiment that's in these two candles to push the market down. So until we test 1246.01, I would expect the market to drift off a little bit, maybe see a spike through this level here. If we don't get down to these levels here, then we use these points as buying back and letting that bearish sentiment, again, get taken out of the market, people to find value in the market to push back up. So again, the imminent bull reversal, which is after this, is what you're looking to kind of look for them quick snapbacks. The increasing bear sentiment leading to a reversal is trying to pick out that point before the sentiment changes, before all the extra buyers come into the market. So we could see again on the hourlies that we might have to endure a bit more pain from the downside to go further oversold below the 30 territory, and then obviously the sentiment is recalculated, and we'll tell you that an imminent bull reversal is on the cards. So right now you're either looking to sell into these levels of support and a potential breakdown here, or you're waiting that to happen for the sentiment to get lower, to change to the imminent bull reversal, and to buy back into these areas of profit. Okay.